future. We're talking real money.
Well, since for some strange reason you tend to forget this phone number, I'm going to give it first. All right, this is the phone number with which you contact us live on Saturdays from noon to 2 in Seattle, 3 to 5 Eastern, when we hang out and talk about real money. The number is 855-935-TALK. That's 855-935-8255. Hello, everyone. Don McDonald here in Florida. Over there in Seattle, well, Bellevue, is Tom Cock. Welcome to our little get-together. We're glad you're there. Thank you for listening on the radio. Thank you for listening to the podcast. We hope you're having a wonderful Labor Day weekend if you're listening to us live. We hope you had a lovely Labor Day weekend if you're listening to us some other time. There. Have I covered all the bases? All the preliminaries?
I think that's pretty much it. We could just sign off right now and head to our cheeseburger in paradise and call it a day. So
I knew you were going to manage to sneak that in somehow. I just knew it was coming.
And you know, the one I'm working on for you is changes in latitudes, changes in attitudes. That's what I'm looking for.
No hope for either. Well, we want to start the program off with a really big thank you. This is a truly selfish. This is not an unselfish act on our part. This is a truly selfish act on our part. We want to thank you for continuing to make all the mistakes you make as investors, because you are so good to us and so good for our futures. You provide us with incredible job security because no matter how much smart people try to tell you that what you're doing is wrong, you continue to do wrong things. And our good friend John Reckenthaler recently wrote a piece at Morningstar with 3 investment mistakes to avoid. Well, okay, he may have gotten 2, but I don't think he nailed 3. The third one's really weird. But but these are mistakes that we continue to make despite the fact that we know they're mistakes.
Yeah, I mean, and the thing is, if you read the words, you just a little logic. One said one investment had a goal of outgaining cash by an annualized 10 percentage points while, and here's the quote, generating returns in times of rising or falling equity markets and both low and high market volatility.
Wow. Is that the magic fund?
That's a sprinkle the dust and it works. So the mistake number 1 is aiming too high, of believing claims like that, believing, well, yeah, the rules apply to those people, but not to me. I can, okay, it seems too good to be true, but it really will work. I was just watching another one on TV where they were scamming somebody to the tune of they provided a return of 10% a month. Anyway, so I would hope you.
Well, and what I find interesting is that the product he's talking about is from a German insurance company, financial company called Allianz.
Yeah.
And they said that you mentioned that they were going to generate returns in times of rising or falling markets. And the author of the article, John Reckenthaler, says technically they followed through on that claim. They generated a return. It was just negative.
And it was big in 2020.
It counts, but it was negative.
And then he goes into the example of Evergrande. I call them
Evergrande. Yeah, the Chinese real estate company.
Yeah. That claimed they had a guarantee of 11.5% a year. 11.5% guaranteed rate a year. There's nothing.
Well, and again, that brings me back to the question.
Come on.
Guaranteed by whom? Who's guaranteeing it? If a company is guaranteeing it, it's not a guarantee because there's only the company backing it. And so therefore it's only as good as the company backing it. You can't really count that as a guarantee, which is one of my issues with insurance companies guaranteeing things. Is it really a guarantee when they promise to give it back to you?
Yeah. It's a guarantee as good as their stability. And by the way, we had a rather large insurance company that almost went bye-bye if it hadn't been for our tax dollars.
Yeah. So the first mistake Aiming too high, he says. Going for too much. Yeah, greed. We'll get to the next one really soon. Give us a call, 855-935-TALK.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to Talking Real Money. Don here, Tom there. We're talking about money and the mistakes you make when you manage your money, actually invest your money. And this is from a piece by John Reckenthaler on Morningstar. And mistake number one that he talked about, and this was a pretty clear-cut mistake. We believe this mistake is the one mistake that he nailed. He absolutely nailed number one. Number two, number three, a little bit of a whiff. But number one, he nailed it, and that is basically, he calls it aiming too high. We just call it greed. Stop being greedy. Now, number two is about, and actually this is one of the laws of financial physics, the more complex the investment, the worse it is for you. Accepting complexity.
Yeah, he kind of agrees with you on your book there.
Yeah,
but not completely.
It's like
he says several.
It's a tipped ball. It's a tipped foul.
He says several famous hedge funds have posted excellent long-term returns while using strategies that can't easily be described. But he does admit the odds do not favor intricacy. And the top 20 performance he mentions in exchange-traded funds, mutual funds, have adopted straightforward approach. In other words, I own the S&P 500. I own small cap value. I do this. They don't mix it up the way we talked about at the beginning of the program, where we make money in every market, Don, whether it's up, down, sideways, whatever it is. It's going to be easy because we know how to play the options market. They don't do that. And I think, really, we've talked about this a lot. The more complex, usually the greater cost, for one thing.
Right.
Usually the more tax inefficient, for another thing. And usually underperformance. Yeah, so it's just, we kind of see this on a regular basis. And you've heard this expression, although I don't like it either, that don't only buy something you completely understand. Well, there's going to be a lot of things in a general sense you may or may not understand, but you can understand diversification. You can understand indexing. You can understand how much you're paying. Those things you should be able to understand. But what he's talking about is very sophisticated strategies that are blow up.
And when he talks about the several famous hedge funds that they may have been better than, they did really well, possibly, and they can't easily be described, well, that can mean they just don't want to describe them. And we always forget, because we don't like to believe that things just happen by chance. No, there must be a reason for everything. Life does not happen without a reason. Well, the fact is there have been a lot of studies done, a lot of great work done that shows that the vast majority, and I'm talking about as high as 99%, of the outperformance that some managers have shown in the past is attributable to just good luck. So the ones that did really well could have just been those hedge funds that did well, because the curious thing about hedge funds is that in aggregate, hedge funds underperform the S&P 500. So,
and our pal, I'm forgetting his name.
Wow,
Mr. Buffett, the other
having
Buffett,
some senior moments, Mr. Buffett.
The other Buffett, Warren.
Yeah.
he did that great bet a number of years ago where he said, I'll take the S&P 500. You can take an aggregate of performance of hedge funds. We'll see who wins. And he won. So I think that's very, very clear. And for us, as it's been for a long time, keep it simple.
And apparently before the show, Tom was so distraught about the passing of Jimmy Buffett that he wasted some time and wasted away in Margaritaville before the program.
Got up this morning and
I'm going to go to Margaritaville in honor of Jimmy.
I should have stuck with the cheeseburger. It would have been better.
He was worth $1 billion.
Yeah, and there were people. I was reading one of the obits today that
Speaking
people used to complain to him that, like, dude, you're just a capitalist. He's like, yeah, I found something that worked. I never. He admitted I'm not a great singer. So on the guitar. But apparently people like this whole, what do you call it, Gulf Western music, Gulf and Western. I mean, apparently they like it. They like hanging out, having a margarita, maybe eating a cheeseburger, having a good time, and that's a good brand. So, it kind of works.
Just down the street, we have a big Margaritaville resort where we go hang out sometimes.
There you go.
Wasting away, as it were. We've got another one for you in just a minute. Another one of these mistakes that investors make that we really do take some issue with. But before we do that, we want to remind you that our number is 855-935-TALK, 855-935-8255. And let's go to Richard. Hi, Richard. Welcome to the show.
Happy Labor Day weekend.
Same to you.
Well, I've got a question. I got a text from my son the other day. He works for a large company. And he said, Dad, I'm offered a deferred compensation retirement savings plan, and I'm thinking about doing that versus an IRA, a traditional IRA. I don't believe he qualifies for a Roth. Not knowing much about a deferred compensation plan, I figured, well, maybe I'll bounce it off you guys and see what you have to say.
You would be able to put more away generally in the company-sponsored or organization-sponsored plan like a deferred compensation plan. Remembering that in an IRA, and how old is your son?
He's 44, I believe.
Okay. So the maximum he could put away in an individual retirement account would be $6,500. He could put away far more than that in a deferred compensation plan. So that's one. The downside is what is available to invest in the deferred compensation plan. Because if the choices are lousy, and we oftentimes see some pretty crummy choices in these plans, then it makes more sense to, start with the IRA, and then maybe if you still had money to set aside, then put it in the deferred comp. But there really isn't a right or wrong that I know of. Don?
No, I agree. It's with everything else, it's it depends. The choice thing is the biggest issue of all, because we see so many of these company plans that do have terrible, expensive, actively managed, overpriced choices that don't give you great diversification. So that's why often you want to sit down with all the details of the plan. You want to look at what's available, what the fees and the costs associated are, what kind of products you can get, and compare that with what you could do in an IRA, or he could do a Roth. He could just backdoor his way into a Roth.
So the fees are the key element here, it sounds
fees
like.
And choices, fees and the quality of the funds. If it's a bunch of actively managed funds that are basically blue chip growth funds with a bad managed bond fund or two, then that would not be a plan that I would want as my first savings vehicle.
Okay. He can do both, couldn't he?
Yeah, absolutely.
Yeah. Mm-hmm. Yep. Anyone in a company-sponsored or organization-sponsored plan like that can, in addition, do a individual retirement account, and depending on your income, could do a Roth IRA as well. So those things still exist.
Or you do a non-deductible IRA
Correct.
And put it and backdoor it into the Roth.
Backdoor it into but yes, those things are still available to him, even if he's in a employer-sponsored plan.
Hope that helps, Richard.
Well,
thanks. Thank you very much for calling. Our number is 855-935-8255. 855-935-TALK. It's anything and everything that has to do with money and investing and saving and spending and stuff like that. We'll be back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hey, hi, welcome. I'm Don. Tom's there. This is Talking Real Money. the radio show and the podcast later. By the way, this week, the podcast will air on Wednesday and Thursday because Monday is a holiday.
No one's going to be working except the two of us.
No, actually.
You're going to be working, right?
Actually,
Oh,
yeah.
what are you doing?
No, I'm going to have everything done. No, I'm going to have everything done. And Debbie and I are going to, on Labor Day, we're going to go to Vero Beach, Florida for a couple of nights.
Love it.
And because she's visiting with a doctor there, so we're going to make a vacation doctor's visit out of that. So we're going to go to the beach
Love
for a
it.
little
Well,
while. For actually on
Good.
Labor Day, I'm going to drive and not work, but I'll be driving, so like work.
I'm going to do some work, but I'm going to go see Oppenheimer so we can compare notes after that.
Oh, I liked Oppenheimer a lot. 855-935-TALK is our phone number, 855-935-8255. John Reckenthaler recently wrote an article for Morningstar about 3 investment mistakes to avoid. And we love number 1, which is aiming too high, or more simply, being greedy. We liked much of number 2, which is avoiding complex, and he calls it accepting complexity because it's the mistake. We'd rather turn that around and say avoid complex investments.
Yeah.
Is that a better way to say it?
Keep it simple.
Finally, the last one, and this, we're saving the worst for last. This was where he should have stopped at 2, because he calls mistake number 3 flying blind, Tom.
Yeah, and he says it's crucial to receive timely news on portfolio holdings.
Is it?
I couldn't disagree more.
Yeah, me neither.
I don't think
you don't want to know.
And if you're in something where you have to keep track of it, then you shouldn't be in it. This is why we recommend index funds, for example, because in an index fund, you kind of know what you own today,
Or
pretty
in
much
a
tomorrow and into the
rules-based
future.
fund. Even in,
Right, exactly.
an active rules-based fund, you know what you're going to own. What kinds of stocks will always be there. Although, and here he's saying you could have avoided that Allianz fund by paying attention. You could have avoided it by not getting in it, by get this, realizing it was too good to be true. And forgive me for a minute, I have to rib some people. Arkansas Teachers Pension Plan.
Oh, I was waiting for this.
Too good
How
to
about
be
Milwaukee?
true. The city
of Milwaukee.
Hey, city of Milwaukee, it was too good to be true.
Yeah. And,
Blue
here's
Cross
all
Blue
joking
Shield.
aside, they
Too good to be true.
have people that are paying attention to. They have hired consultants who come in. This isn't just somebody sitting around picking them. They got hired consultants, experts who look at all the possible world of investments and say, hey, city of Milwaukee, you should do this, 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 and this.
Right. Well, no,
Boy,
the
how do
city
you
of
blow that
Milwaukee
one?
has their own people who are supposed to vet
In
it.
addition, probably to outside consultants.
So
Yeah,
to
no,
say
I mean,
that
so it's
somebody
crazy.
is making a mistake by not paying attention, for these big organizations, these institutional investors, it is their bloody job to pay attention. You have no
Indeed.
excuse.
Yeah, couldn't agree more.
It's your job. You're supposed to pay attention. And then he goes, well, you shouldn't, the Evergreen product, you couldn't get any information. Well, then why would you invest with them? I mean,
I think these are good. I would add to this list a couple of things, by the way. Recency bias. I think I see that. I think that's number one.
Explain it. I think a lot of people are going, what the heck is he talking
what's
about?
happened recently will continue to happen. For example, you should have all your money in AI stocks today, right? Because they've had a great year. Got to run and do that. Or the last few years, the S&P 500, because that's been the king of the hill. I got to put my money there. Those are easy, right? That's an easy place to put your money. Things like that where people say, well, it has to continue. No, it doesn't.
No,
in fact,
it doesn't.
More likely it won't.
And again, another big mistake is not diversifying your portfolio, because diversification is going to bail you out of a lot of stupidity.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Our goal here on Talking Real Money is to help as many people as we possibly can, which is why... Are you clicking over there?
No, I'm not clicking. It's warm here. I'm not shivering. I'm not doing anything. I'm sounding good.
I hear a clicking sound. Anyway, we're here to help everybody. We want to help you. Give us a call at 855-935-TALK. And by the way, the best time to call is when we're actually doing the show live, which is Saturdays, noon to 2 Pacific, 3 to 5 Eastern, 855-935-TALK. But a lot of people go ahead and send their questions in through talkingrealmoney.com. Like you have one, don't you,
Yeah,
Tommy?
I mean, and some people take umbrage with our statements, so we're happy to discuss things, to argue things through, or just say we're wrong, because sometimes we are wrong.
If we are wrong,
I don't think we are this time, but
all right, let's
this
find out.
Comes from somebody named Serdar and in beautiful Salisbury, Maryland. Wrote, on the show, Tom and Don were mocking the Investors Business Daily regarding the article advocating 10-year CDs. Now, I'm just going to stop right there and tell you the reason I was mocking them.
Well, I was too, yeah.
Yeah, the reason is what they said was, here's an easy way to get 5% a year for 10 years. And then they went on to say you can't get it. But Mr. Serdar says, or Ms. Serdar says, you can.
You can?
He says, I recently came across a 10-year 5.4% CD from Wallkill Valley Federal Savings and Loan Association. Now, I shop across the street from Wallkill at Roadkill, but that's a different than I think the rates are not as good there.
There was a joke. I just didn't know what it was. I knew there was one coming.
It just had to be there. You're undermining your own credibility by building a case on incorrect or incomplete information. Okay, just for the record, just so we're all on the same page. We don't come up with these rates on our own. There's a thing called bank rate.
Up. Yeah.
Oh, you may. Don's down in the basement printing up. No. We're only going with 4.3 this time. No. I just go to bankrate.com. I can't find anything of that level. So then I just did a general search this morning for like a 10-year CD. The best I could find was 3.8.
That is the best I can find too.
So I don't, and all joking aside, I don't know Wallkill Valley's Federal Savings and Loan Association.
Okay, well, I went to their website.
Smart.
And guess what they don't have?
A 10-year CD paying 5.4.
They don't have it. Now, it is possible. I'm not going to call this person a liar. No. But it is distinctly possible that they ran some sort of a quick little teaser rate for, certain customers.
Like 10 minutes or
open
something?
A checking account and we'll give you a 10-year rate.
By the way, I would only take the toaster myself, but that's another thing.
They don't do They don't do any
reliable.
of that stuff anymore. They don't do any of that.
Okay, how about the air fryer?
And actually, I would take that 10. I would take that 10-year 5.5% CD.
No, funny, when I was reading this note, I was like, it's pretty tempting because wow, guaranteeing yourself 5%. Even in a relatively high inflationary time, that's a pretty good deal. So I can't find that, and I think, this is an area that we've discussed ad nauseum, whether to be in CDs or bonds, for example. How long a maturity you should lock up. I mean, there's a lot of debate we could have about that, Don.
Yeah, and I am looking at Bankrate, the best rate on a 10-year. Your phone, you're putting it close to something. I just noticed. Yeah, that's where the noise is coming from. Discover Bank, 3.8, 10-year. Okay. VO Bank,
pretty good, but
2.75. Immigrant Direct, 2.75.
And here's the thing about this discussion. It's still like 3/4 of people have most of their money where today?
In cash.
In regular checking accounts that are making nothing. So if you just did anything to get better than you do, this is a very small part of the whole world is what I'm saying. So at least get it out of that bank and move it to somewhere where you're making something. It would be better.
A lot better. And give us a call, too. Just call. Call and we'll talk. We'll talk. 855-935-TALK. 855-935-8255. It is some of the most critical conversation that goes on anywhere. There are other times. But this politics, really. How much is a conversation about politics going to change your life tomorrow or the next day or into retirement? It really isn't. I mean, all we do is we just yell at each other. But here's a place where you're getting some really solid, actionable advice and information that if you would listen, we are confident that you will do much better than you have been doing. So give us a call, 855-935-TALK, 855-935-8255, and we'll try and make your financial life better, your future better. eliminate a lot of the worries and the concerns and get you on a better path. We'll be right back.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
We're just here to help you deal with your money better than you might have done before. Give us a call, 855-935-TALK. 8255. Hey, Andy, welcome to Talking Real Money.
Well, thank you. Thank you. I was listening to you. You said call, so I thought, first time caller, long time listener.
I love it when people say that.
Get it done.
Yeah, thank you for doing it. All right, what's up?
Yep. Well, it's where to park the emergency fund, and I'm trying to avoid hodgepodgeitis.
Yeah. Okay.
And where I'm banking with USAA, and for years we've just put our emergency fund in savings. However, the banks anyway. There's more interest to be made, but I don't want to just open up online banks everywhere. So I'm trying to figure out where to put that money so I just don't have money going.
How much?
Everywhere, so to speak.
How much?
Hodgepodgeitis.
How much?
Oh, 30,000. 30,000.
And do you have a brokerage account where you have just a regular brokerage type that's not an IRA or Roth IRA?
No. We've. That's why I've just kind of paralysis through analysis. I want to do Fidelity, but I don't know if that would be if they have something there I can use and how quick, if I need the money. Sort of deal.
Let me tell you.
We've got Roth.
Let me tell you, banking to me is not hodgepodgery. Banking is generally a place where you park that money that you might need, and you really do want to make the most, but you don't need to open a bunch of different accounts. I have mine with Bread Financial.
I think mine's at Basque.
Yeah, Bread Financial used to be Synchrony, I believe. No, Synchrony? One of those. One of those. They changed their name. It was one of those credit card lenders. But right now, though, if you went to Basque, the one that Tom mentioned, or you went to CIT, these are consumer lending banks, but they're FDIC insured, you can make 5% on cash.
And they're very easy to set up. It's very easy to move the money back and forth.
Gosh,
I've done it a couple of times.
Easy.
Bing, bang, boom. And yeah, I think that makes a ton of sense. The reason I asked about the brokerage was if you had a brokerage account, you could get into a money market there at Fidelity, which is still probably paying 5% as well.
Yeah.
But I think that just a high yield savings account, one of those online brokerages, hook it right up to your regular bank account so that when you need the money, you can get it.
Yeah, that's the trick. You hook it to your bank, then I just log in on their app on my phone, and I go, send money to my bank account. Bing! And in 2 days, it's there.
Okay. Follow-up question. When you said money market, I'm stuck in the paralysis again with money market account versus money market fund, and that's where somewhere I'm just don't want to pull the trigger and put the money where it's. So if you could help educate me, because online reading has got me more confused than unconfused.
With good reason. Money market accounts are just fund. Money market accounts are names for bank accounts at banks.
Yeah, that's it.
Now they call them high yield savings. Most of the time.
Oh, okay.
Money market fund is a different. That is actually a mutual fund that goes out every single day and buys short duration commercial paper and bonds, very short-term treasuries and the like, and tries to get the best yield that they can day to day to day. Every day the yield changes because their portfolio is changing every day. So the one thing that a money market fund lacks, money market fund lacks that a high yield savings or a money market account has, is FDIC insurance.
But at 30,000, you don't care anyway, really.
Well, I mean,
you don't want to lose 30,000, but I mean,
a money market fund. We've only had one money market fund, I think, that ever broke the buck, that ever went below $1 a share. Yeah. They price every day at $1 a share and adjust the yield accordingly. And it only happened one time, and I think it was 08.
08?
It was 08.
I think it was. Yeah.
Oh. So they're just a little less safe, but
I would, if it was my money, I would go online. I'd go to bankrate.com, look at the best rates for high yield savings accounts, open one of those, move the money over, hook it up to my bank account, and get on with my life. Be that easy.
Don't think about it too much.
Okay. All that thinking, Andy. Come on.
Think of all literally on $30,000, think of all the money you've lost thinking about it.
Yep.
Go do it.
I appreciate the call out to call. So
thank you, Tom and Don. Today. Seriously. Go set up the account today, attach your checking account to it, and the money will probably be in there Wednesday.
That's about right. Fantastic. Tuesday, boom, it moves. Yeah.
Okay. Good luck.
All right. Thanks,
Andy.
Thanks for calling, Andy. Oh, I love first-time callers, long-time listeners. Long-time listener, first-time caller. 855.
You don't hear it much. Yeah.
No, 855-935-TALK is our number. And Savad, welcome to Talking Real Money. Savad,
you may want to turn down
your radio down. Turn your radio down. Or not. See, that delay confuses people.
Yeah.
All right. Well, that's not working.
Moving on.
So we're going to move on to Bob. Bob, welcome to Talking Real Money. Hi, Bob. Bob. Now I hear just total silence, which is never a good sign.
Not on radio. Sometimes at home it's good.
Dead air is not our friend.
Bob?
Is Bob not there? Bob is gone. All right.
Everybody left us. Okay. Well, that happens too. I see that. We're okay.
Do we have time for another question? Or
I've got a ton of them, but they're not right here with me.
Oh, well, then
I forgot to bring my stand.
Never mind.
My question is, what is my question? I don't know that I have a financial question right now.
No, you don't. You come on. You answer. This is what you do. You answer them.
I know.
But back to Andy. I just want to mention that this is when we're talking about. I know that we scare you when we talk about hodgepodgeitis. When we talk about hodgepodgeitis, I want to define it. That's when you have a brokerage account or an IRA or brokerage accounts and IRAs or 401ks, and you have dozens of different mutual funds that aren't part of an overall plan. They're just
or you can have many. I've run into people that have 3 IRAs, 2 Roths, old 401ks. That's a hodgepodge, and that's bad news.
It's basically having too much stuff that doesn't work together as part of an investment portfolio unit. When it comes to banking, that's a different world entirely. Your bank is where you keep the money you need now or in the very near future. That really is not, and as a matter of fact, it probably shouldn't even be considered part of your investment portfolio for those purposes, because you shouldn't have more cash than you need for immediate needs and emergencies. That should be the only reason you have non-higher potentially yielding securities. So
and the other part is, frankly, with Andy, build a plan, know what you're trying to do with that $30,000 and get it done. As you said, do it today, get it done, get it off your list.
Just get it done, and then you don't have to think about it anymore, and you can go do something fun. Like go to Vero Beach, like we're going to do. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You know, as they say in Appalachia, just get her done. Get her done. Get her done. Just do it. Just go get it done now. Do this planning thing that you do not do well.
Yeah, and one of the things we do see is people, it's inertia. I got other things. I got the garage. I got the lawns. I got the kids. I got the grandkids. I got 100 other things on my list. But having a financial plan, having the right investments, just having things put together in a way that's properly organized can be a huge relief. So, yes, get it done, Don. Absolutely.
And if you want a little help getting rid of the hodgepodgery, meet with one of our advisors. It's free. Go to TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.